All right, it's a few minutes after 8, so I'm going to get started. This is Ken Long from Tortoise Capital. We're coming from Raleigh, North Carolina tonight. We just finished our 3-day live trading workshop here with the International Institute of Trading Mastery, and we'll be starting our live trading workshop tomorrow for a couple days. So it's been good times and lots of good work so far. So this is the weekend trading report for July 19th, 2014. We're in bullish normal conditions. It just went into normal this week. On an annual basis, using weekly RSI 14, we're at 71 out of 100, so overbought. Using the 10-day NDX for short-term market context, we're also overbought at 83 out of 100. Looking at some of the elements of the market mosaic, percent stretch relative to the 200-day moving average is white bullish at 7.97%, or 6% cushion between current price and sideways markets. Slope of the 50-day moving average is white bullish at 0.54. That's healthy. ADX has declined to 19.9 after a high of almost 35, and the bears are in charge based on that sharp sell-off on Thursday. The risk index is the 30-period moving average of the VIX divided by the 10-period. The boundary between risk on and risk off is 1.0, and currently it's, I just had a pop-up for a excuse me, just had a software update pop up. There we go. So the risk index is the 30-period moving average of the VIX divided by the 10-period. The boundary between risk on and risk off is 1.0. The current reading is at 0.96, so the risk off position is favored. Unrisky assets, as it were. When we take that score of 0.96 and compare it to the last 5,000 trading days and take the standard deviation, we find the z-score to be minus 0.6. This is a histogram of the last 90 days of that indicator, and you can see that we're down in spiky VIX dominant territory, and that's a function of the last 3 or 4 days have been extremely volatile. And so the VIX is definitely in play for a one-day intraday trade. The blended monthly rebalancing is due to be updated on or about 1 August. Current holdings are noted here on the ETF 13, 22, and 32. And then in the current leaders box, we have the winners in these various populations as of Friday. In ETF 2, the theoretical exposure of the model is at 90%. The model portfolio itself will be at 100% exposed. This is the ETF 13 and 32 portfolios, just showing what their current holdings are and the current ranking of the ETFs. You see that technology and Brazil are dominating the list, with the Russell 2000 still at the bottom in ETF 13 and lagging badly. This is the ETF Max, looking at it through the blended monthly rebalancing framework. Notice the a little bit of weakness creeping into the gold miners. And this list is still dominated by India, Brazil, Turkey, biotech, energy. This is the ETF, the S&P 500 blended monthly rebalancing lens, and it adds the sector spider that each of these symbols is a member of. And technology and energy are at or near the top. I'm interested in Gilead Sciences and TripAdvisor, since they are green and white, meaning that they are recent additions to the top of the stack here, along with Jabil Circuits and Moody's. And then we're starting to see some weakness creep into EOG Resources, Baker Hughes, and Marriott. This is the market health check. Vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal red lines are support levels that used to be resistance levels and would act as price targets on the way down if price collapses through them. The dark blue shaded area is the Bollinger Band mean plus or minus 1, so it's a Bollinger Band 30 plus or minus 1, that's the river. The lighter blue shaded area is plus or minus 2, that is the floodplain. The outer red boundaries are the Bollinger Bands plus or minus 3. The black channeling line here is the 30-period regression channel, the RAF regression channel 30. The center line is the regression line on price. The outer channel is formed by the maximum excursion during the look-back period, and you can see that it's still sloping up. The blue channel is the 10-period. Both of these channels have current price right in the middle of the channel, so there was a healthy rebound on Friday after the sell-off on Thursday. The sine wave looking thin black line is the slope of the 30-period regression line. In the blue circles you can see where it crossed the zero line and went negative, went down for a few more days, then came back across to the upside, and then never looked back. Got very steep up here at almost 0.30 slope. It takes 4.0 to be statistically unusual. And then it's rolled over the past 15 days or so and has decayed back down to normal territories. It takes the slope going underneath this dotted line to show negative. So a lot of the steam has run out of the market here lately. The solid purple line is the all-time high. We want to see a price close and hold above that purple line to really say that the bull has resumed. Off to the right, you see the green, yellow, and red regions. Those are my intuitions or feelings about where I have directional bias. As long as price is in the green zone, I have a long side bias, and I'm ready to go that way early intraday. In the yellow zone, I have no directional bias, and I'm waiting for the market to point the way for the day, and then I'll try to pile in. And then in the red are prices where I would have a downward bias and looking to get short at the earliest opportunity intraday. See on Williams percent R, we're just about overbought. It can stay that way for a long period of time. You see the jaws of PPO have opened to the downside, and that's a warning about how fragile this market is. You add that along with testing the bottom of the regression channel, the VIX sell-off on Thursday, the risk index is in risk-off mode. You can see the trendiness declining, the bears in charge on ADX. This is multiple cautions that ceiling at 200 in SPY might actually be a tangible thing. This is the ETF2 model. You can see that 9 out of the 10 regional ETFs are on buy signals. So that puts us at a theoretical exposure of 90% invested, 10% cash. Bull normal. The S&P at 77 is better than EFA, the rest of the world, at 74. So the U.S. is favored for short-term positions. Inside the U.S. indexes, technology at 80 is better than XLK at 77, and SPY, at 77, and then MDY at 75, and then the small caps at 72. Its two strongest sectors are U.S. tech and then Latin America, followed by the two weakest, which are Russell 2000 and then the European 350. In the sector spiders, we have strength leadership in technology at 79 and energy at 79, and then weakness in the industrials at 74. Next up is the world market model. All the large caps in the U.S. are above average, except the technology is exceptionally above average. The value and blended mid caps are doing well, but the growth mid cap is lagging, and all the small caps are lagging. Europe is in the yellow, as are the European countries, except Austria, which is red, and UK, which is green. The Australian and Asian sectors, Australia above average, along with Malaysia, Singapore, Taiwan. India, Thailand are extremely strong. Weakness in Vietnam, South Korea, Hong Kong, China. Latin American emerging markets above average. And then in the Western Hemisphere, Canada and Brazil are especially strong, and Mexico above average in the white. Next up, we're going to go straight to the Tortoise Daily Report. On the summary page, no signals in overreaction and channeling. You can see how the volatility has crept back into the market and moved this out of quiet into normal. See the in ADX just starting to pick back up at 19.5, but the bears are in charge, so that's a bit troublesome. 10-day Max Payne's got some good candidates in Johnson & Johnson, Intel, GE, Home Depot, and United Technologies. Then you can see in the swing trade summary, we have overreaction signal in Johnson & Johnson, triple screens in silver and the VIX, 551W patterns in mid caps and energy, and then in the auto framer, half a dozen quality signals with McDonald's, United Tech, and U.S. small caps leading the way there. The Dow 30 tactical summary. No RSI 2 scores, lots and lots of frog quality numbers in excess of 3. The winners from Friday are highlighted in blue. The laggards are in red. We have one overreaction signal in Johnson & Johnson, a couple 551Ws in Nike and Disney. And then 3 auto framer candidates with Johnson & Johnson, United Tech, and McDonald's. Next up is the ETF 30 tactical summary. Again, a handful of dojis. We have a triple screen in silver and the VIX, 551Ws in mid caps and energy, agriculture, mixed commodities, the Russell small caps, and gold all test out better than 2-to-1 on the auto framer. The auto framer shows all the mechanical data required to support your trading, the development of your trading plan. And in the regression line fractal framework, which was a really popular addition to the workshop this year, you can see the winners and losers of relative strength in the Dow, the ETF 100, S&P 100, the NASDAQ 100, and then the S&P 500. Last charts, market mosaic. You can see we're underneath the water here a little bit on the regression line. It has come back and joined its 10-period moving average here at the 0 line. So we are due for a trending market here. There's no indication of direction. The slope of the 30-day regression line with its own 10-day moving average. This is the 180-day look back. Sort of a poor man's market health check. to break back exactly to the 6-month average, which has been up, but it would not be unusual to see that overshoot to the downside. In my view, as long as it stays above the 1 SD mark, then we should be in good shape. This chart shows some additional indicators. You have the regression line slope now looking back 10 years and finding how today's slope fits with respect to those longer look-back periods. And we're still in the upper half of the first band around the mean, so that's still pretty good. And that's everything I wanted to cover from the charts. We'll take a quick look at some charts of interest. Stand by, let me get that loaded up for you. Okay, so the first one we want to look at is McDonald's. We like this one. It started to make a universal entry yesterday. It's a Z trade, a pattern 7 RLCO candidate, with starting to find support here at the bottom of the move, which is also resting on the -3 sigma, so it creates some opportunities to the upside with the re-entry either at the edge of the river, middle of the river, north of the 70, or upon entering the river. That would give us a 2-to-1 to the far side of the river. So it's been kind of an orderly sell-off, and this is a long-term must-own symbol, but we can see that it's come all the way back. There was a downward trend that caused the 270 to slip downward. This price action that I'm circling was enough to get that 270 to nudge northward. Now had a nice trade and a little bit of trade decay here, but that's caused the 270 to get straight up, although it's just slightly starting to roll over. So what we have here is still a fine opportunity for McDonald's to get its act back together. Let's see if we can frame this trade up a little bit here. All right, so if we can get support here, if we had a nice orderly entry in here around 98.75, then we would consider buying this at about 99 even, with profit targets at the edge of the river, middle of the river, far side of the river, and the upper limit of the third Bollinger Band. On the other hand, if it does fail through 98.25, certainly we have no compunction about going short this one. Next up, we want to look at Intel. So we got another bump up this week. So here was the last gap opening up and go until this one, where we had another nice gap opening north and go. and it got as high as 34.80. Has decayed a couple days in a row, but still holding the support of that the lowest low of that candle. If it were to violate below there, then the play would be short to the Bollinger Band mean. But if it holds it here, otherwise we get a lazy W and off it goes. Should be a pretty interesting story for Microsoft here shortly. So we'll look at Microsoft next. I said Microsoft, Intel, excuse me. We'll look at Microsoft now. That's another relative strength leader that's starting to show strength on blended monthly rebalancing. This is the breakout candle. However, we're starting to see some divergence here. The 270 is out here. So again, we have an opportunity short from 44 and a quarter down to 42 and a quarter, so $2 of potential on the downside in Microsoft. Even if it fell that far, it wouldn't jeopardize the strength of this trend. I really think, though, we would want to see this find support internally and then move north so that we can start building the bench. All right, that's everything I want to cover. Oh, let me get one more here. I'm sorry. Let's try Johnson & Johnson. This is number one on the max pain range compression, and I like I love this chart. We have had 4 days of continuous powerful selling pressure, 1 day of upward buying pressure with a higher low, and price decayed as far as the -3 Bollinger Band. It's still at the 270, right at fair value. So how far can the aggressive ones push this price north? Approximately that far. So it remains to be seen if this is an indication the market has cracked. The Friday's price action was useful to the upside. It healed quite a bit. And so I'd be willing to play second day momentum on Monday on this one. And that would feature an entry hopefully in that 102.30-ish range. Bollinger Band mean, the far side of the river. And yeah, the actual far side of the floodplain is the upper limit. So this is the number one max pain range compression pattern going as well. So that's everything from Raleigh. I need to hit the sack. We're starting to fade out here. We got a couple full days of live trading going on, and we want to be ready for that. So we'll participate in the chat room with you and try to indicate what the guys are looking at and share some trade frames with you. And looking forward to the next couple of days of live trading again, and get a chance to spend a little more time in the chat room than I have lately. You guys all take good care and keep your risk measured and your powder dry, and we'll see you in the chat room.